Greetings class and welcome back. This is the chapter 3 video for job order costing for the cost flows. And if you look at the very beginning, we have some learning objectives that are basically to know what the cost flows are and understand what they are, to use the T accounts, to prepare the schedule of cost of goods manufactured and cost of goods sold, and basically to compute the over-under applied overhead. All those things we've been doing in class, but I wanted to prepare this video so you could look at the book, refresh your memory, and maybe use this as a study guide for some of the things that are coming up. So here are important terms. We've talked about all of these except absorption costing, and that's what we've been doing. Absorption costing considers the direct costs and the manufacturing overhead costs that go into the product. So absorption costing is really what we've been doing, because it considers direct materials, direct labor, fixed and variable manufacturing overhead. All of those are product costs. The allocation base, well, that's either in this case many times direct labor hours or machine hours. The predetermined overhead rate is the total of the estimated manufacturing overhead divided by the estimated total of the base. Applying it is taking the predetermined overhead rate times the amount of the allocation base. So job order costing, when we talk about the flow of costs, we're talking about the raw materials purchases going into raw materials, direct labor and manufacturing overhead that's being assigned to a product goes into work in process, as well as the materials that are moved out of raw materials and into the work in process. And then when we finish with products, we're going to move those out of work in process and into finished goods. And those finished goods are really what's available for sale. And then when we sell them, that cost is going to go into the cost of goods sold account. Also, we'll have selling and admin expenses that are a period cost, not a product cost, and those will be deducted or added in, or you'll have the revenue minus cost of goods sold minus selling and admin cost to get the margin. When you look at the purchase and usage of materials, here's some journal entries to look at. We have a debit to raw materials, credit to accounts payable for the purchase. And then when we move it out of raw materials and into work in process, we're going to take some of the materials out of here, but some of those might be indirect materials. Whatever's indirect goes into manufacturing overhead. So what I really want to look at to show you is this handout I gave you the other day, which shows the movement of the costs. If you're in a manufacturing environment, you're going to have materials requisitions, and you basically prepare those in order to get the materials you need to do the jobs that you're working on. So the materials come into the department, and they come out of raw materials, and then whatever's direct, and they identify that here, of the 52,000, 28 for job A, 22 for job B. A total of 50,000 is direct, so it goes into work in process. The other materials are considered indirect, so they go into manufacturing overhead. Likewise, with labor costs, you're going to see labor costs work in a similar way, although we're not using materials requisition forms. What we have there are timesheets or time records. And based on the time records, you're going to take the total cost of salaries and wages out of, or you're going to take them and assign them to wages and payable, but those costs are also going to go into the work in process inventory for direct costs. And here out of the 75, they identify 60, 40 to job A, 20 to job B. That goes into work in process. The remaining 15 is indirect, and it goes into manufacturing overhead. Okay, then you go, we talk about manufacturing overhead. When we're talking about manufacturing overhead, these are costs directly related to manufacturing. So but they cannot be tied to a specific product. So when we're talking about those, utilities, rental and factory equipment, miscellaneous factory costs, these are all costs incurred in the manufacturing area or the factory area. Those are all going to go into manufacturing overhead. So if we have property taxes that we owe on the manufacturing building, on the factory itself, that goes into overhead. Prepaid insurance goes into overhead. Accumulated depreciation for factory equipment goes into overhead. So manufacturing overhead accumulates everything associated with the manufacturing process that cannot be directly assigned to a particular product. So when we actually come up with a total of work in process that we need to assign out, we're going to track the units, the allocation units, and multiply it by the predetermined rate. In this case, we have 10,000 machine hours for job A and 5,000 for job B. So we take that 15,000 machine hours times the predetermined rate of 6 to wind up with a total cost of 90 that we move out of manufacturing overhead and into work in process. This is identified as a cost of the job because we've tracked these allocation-based units and calculated it. So we're applying this overhead into the job. Manufacturing overhead is really a clearing account where we actually identify costs and put them for a period of time. So in this case, you have the flow of the overhead application being the original amount in the manufacturing overhead account, tracing those job machine hours, calculating the amount you're going to apply, then taking it out. And this is the calculation here, taking this out and applying it to each job. You get a total of 90,000. Now this $5,000 difference is going to result in overhead variations that we'll call over/under applied overhead. When you get to non-manufacturing costs, these are going to be things like salaries for admin and selling. You're going to have a depreciation expense on not on factory, but on the administration offices. You may have advertising or other expenses in the offices. That all is going to go into the period cost we'll call selling and admin expense. So when we actually complete the manufacture of goods, whatever costs we take out of work in process and put into finished goods is going to be the cost of goods manufactured. That's what we will track. So if we look at how that is tracked or how it's calculated, we can create a cost of goods manufactured statement like we did in class. We'll get to that in a minute. But we can also identify the transfer of these goods into finished goods as a cost of goods manufactured. Cost of goods sold, well, when we sell a certain number of the products, we're going to actually calculate based on the cost of goods manufactured what the unit cost is, and then we'll apply that here to the units we sell to determine the cost. So we have the retail value on accounts receivable and sales, but the cost will be assigned into cost of goods sold and taken out of finished goods. These are the journal entries that were in the chapter earlier, and these identify how these transactions are handled. They're also illustrated in this flow chart, basically of T accounts. And if you want to spend time, basically down here at the bottom, you have a legend that basically explains each of the entries, raw materials purchased, and various things. So you can actually trace these entries from the journal entries up above here because the numbers line up with these. So if you want to look at that and spend some time going over it, that's probably a good idea. that'll help you get a handle on how these costs go through the system. Now, when we talk about cost of goods manufactured, we need to put that into some kind of a format or a schedule in order to prepare the income statement and the cost of goods sold. So this is the schedule we prepared in class, where we have, we begin cost of goods manufactured with direct materials, beginning raw materials inventory. We add the purchases. We have total raw materials available, and then we deduct the ending raw materials inventory and get the raw materials used in production. We deduct any indirect materials we identify. In this case, they had 2,000. And then we have direct labor we're going to add in. We have the manufacturing overhead that was applied. We add that in. And this is going to be total manufacturing costs that we identify. So these costs are for direct labor and materials and manufacturing overhead. Now, we need to calculate or allow for the changes in the work in process account. So we add in the beginning work in process to get this subtotal, 230,000, and then we deduct the ending work in process. And that difference will show us what the cost of goods manufactured are. In this case, we have 158,000 as a calculation, which matches up with what they were showing us back there in the journal entry. We move that cost of goods manufactured into the cost of goods sold statement because we're going to use the cost of goods sold statement and begin with the finished goods inventory. So we have 0 in finished goods inventory in the beginning, but we add 158,000 in for the manufactured goods. The total of those two is goods available for sale, and then we deduct the ending finished goods inventory to calculate the unadjusted cost of goods sold. Now remember when we were looking at those T accounts and the charts that show the flow of costs, we had a $5,000 balance in manufacturing overhead. That's an underapplied overhead amount. That means we need to add that overhead into the cost of the product here. And so we're going to do that adjustment, the cost of goods sold statement. So actually, our calculated cost of goods sold was $118,500, but the actual amount is going to be adjusted to be $123,500. So the overapplied overhead is added in here. If it's overapplied, we would deduct it. If it's underapplied, we add it in. So when we talk about total manufacturing costs, what that is direct materials, direct labor, and manufacturing overhead applied. The cost of goods manufactured is the total manufacturing cost, these, plus beginning work in process inventory minus ending work in process inventory. The unadjusted finished cost of goods sold is the beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. So that kind of gives you those cost of goods manufactured, cost of goods sold statements revisited. And then the income statement is shown here. Now when you do the income statement, the cost of goods sold is going to be the adjusted cost of goods sold, not the calculated version. So your gross margin will be this 101.5, and then you're going to take out the salaries, depreciation, advertising, and other expenses to arrive at a net operating income of $14,500. Okay, in this section, they're going to look at the underapplied and overapplied overhead of these two companies. They're going to look at TurboCrafters and Black & Howell, and they prepared estimated data for the coming year. So TurboCrafters estimates $300,000 in cost, $75,000 in machine hours. Black & Howell has $120,000 in overhead costs $80,000 in direct materials cost, which is going to be the predetermined rate is $4 a machine hour for TurboCrafters, and 150% of direct materials cost for Black & Howell. So comparing what they estimated to the actual, Black & Howell had more manufacturing overhead cost and more direct materials cost. TurboCrafters had less actual cost and less allocation base. When you look at what happens when you actually calculate it out, you show that they're applying $272,000 based on the actual, or based on the estimated overhead rate or the predetermined overhead rate. But that doesn't account for the total actual cost that TurboCrafters had. So what you have is an underapplied overhead. For Black & Howell, their rate actually calculates more cost than what they actually had. So you have overapplied overhead, and that's what's shown here. So you compare the actual cost to what was applied in both cases, and will require an adjustment for both. This chart on 310 shows you how this works for overhead. You have the estimated and the predetermined, and then you apply it to the actual to get the total manufacturing overhead applied. And then at the end of the period, you're going to compare the actual with the total applied to see if it's under or over applied. Whatever you have, if it's under applied overhead, in this case that's what they're doing here, you have under applied overhead from our example, you're going to credit manufacturing overhead and debit cost of goods sold in order to get that into the cost of the product. So here they give you kind of a closing of under applied overhead, how that works, and you're going to look at, you have manufacturing overhead applied to production, you have the 60 and the 30, you have finished goods, cost of goods sold, divided by the 90,000 total. For both jobs, for job A, you have 60,000 in here, which is the total cost overhead applied to it. Then you have finished goods, cost of goods sold. This is what's where, divided by 90,000. Same for job B. You have 30,000 divided by 30,000, or 30,000 here, 30,000 here, divided by 90,000. Gives you 30%. So 30,000 divided by 90,000 is 33 1/3%. 45,000 divided by 90,000 is 50%, and 15,000 divided by 90 is 16.67%. You multiply that times the under applied overhead amount to get the amount that's assigned into each job and where it goes. So in this case, $833.50 goes to job A, $2,500 to job B, and $1,666.50 goes to manufacturing overhead. I'm sorry, job A gets $833.50 plus $2,500. Job B gets $1,666.50. I'm sorry, I kind of messed that up a little bit, but hopefully it didn't confuse you too much. Anyway, look at this diagram here, because this is how they are going to, we closed it out, but they're going to actually assign it to the different jobs that they have to assign it to. Okay, the last thing I want to show you here is this model that's kind of a T account cash flow or flow costs using job order costing with normal costing, which is what we're doing. They show the debit to raw materials for purchases, a credit for materials added to work in process, credit for indirect materials. The work in process, they show the debit there for materials, direct labor, and so on, and the credit for goods manufactured. Finished goods, they show the debit for goods manufactured, the credit for goods sold, cost of goods sold debited for the cost of goods sold, Salaries and wages, you're going to credit those for the direct labor and for the indirect. And then manufacturing overhead is debited for actual overhead costs and credited for overhead costs that's applied to work in process. The difference can be over or under applied overhead. So anyway, that's our video for chapter 3. I hope this helps. I look forward to seeing you back in class.